If you're looking for dividend stocks, one of the best places to look, I think, right now is the telecommunications industry. And Verizon is this company that I think investors are still overlooking. We have a dividend yield of about 6.2% right now. Shares are actually on a roll. They're up about 35% in the last 6 months. And there's a lot to like about Verizon's business because it's so consistent. People continue to pay their wireless bills month after month after month. The major investments that Verizon had to make into building out the 5G network has largely ended. The capital expenditure started to slow down last year, and they're going to slow again this year. So that means there's more cash being generated to do things like pay down debt and pay dividends to investors. So I want to dig through some of the numbers today and show just how strong this business is and where there might be tailwinds in 2024. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's look first at some of the momentum in Verizon shares. This is a look at Verizon's stock performance over the last 6 months. You can see 35.8% gain as I'm recording, and you get that 6.2% dividend yield shown right here. But what we really want to look at is the operational momentum that we see at Verizon. This is a look at some of the key operating metrics, and you can see that in the fourth quarter of 2023, the company really turned around what they call their post-paid customer adds. And this is on the consumer side, with 318,000 additions. They actually had some deals for iPhones. I actually upgraded in the fourth quarter, so I was one of the people who, I wasn't an addition, but it was pretty appealing to move to Verizon if you were looking for a new carrier and upgrade to new iPhones at the same time. There was some other smartphone deals and bundles that they've started to add with things like Disney Plus as well. And that's really seeming to have some momentum for the business because this is after 3 straight quarters of net losses. They're starting to add customers. But where they have had a lot of momentum is on the business side. And this is basically the opposite of what you're seeing at AT&T. AT&T is losing business customers and adding consumer customers. Verizon is doing exactly the opposite. The other big piece of momentum, and this is not unique to Verizon, but I think Verizon has leaned into this more than a lot of competitors, is the broadband net additions. 375,000 fixed wireless additions. Fixed wireless is just simply a box that plugs into your wall. I have one sitting under my desk right now, and that provides broadband for an entire house. So instead of running a cable line or a fiber line into your house, you can have a 5G connection wirelessly through Verizon. I've been using this for a couple of years now, and it's faster than cable was. And this is why we're starting to see these kind of addition numbers, 375,000 in the quarter, well over 1 million over the past year. And these are just incremental connections. If you think about Verizon's business, they're going to spend billions and billions of dollars building out that 5G network. And then what they're going to do is sell it in very, very small pieces to each customer. So you're going to pay $50 a month for your wireless connection, another $50 a month for your broadband connection. As long as they're adding connections, it doesn't matter whether those customers are consumer customers, business customers, or broadband customers. As long as the total number is going up, then the business is doing well. So you add these 3 things together, and you get over 800,000 additions in the quarter. So I think that's great momentum for Verizon's business. But here's the other thing is that sometimes the top line numbers don't quite tell the full story for Verizon. You see total revenue was down 0.3% in the quarter to $35.1 billion. But you'll notice that the red segment in here was up slightly. This is services and other. Within services and other, you have total wireless services revenue. This is actually the one number that you want to see grow at Verizon. This is the revenue that's generated from that 5G wireless network they've spent years building, and 4G and all the legacy assets that they have. So as they grow revenue in wireless services, this is 70, 80, 90% incremental margin for each dollar of increase in revenue. The gray segment, most of this is wireless equipment. Wireless equipment, actually, Verizon loses money on. So every time they sell you a new phone, they're actually subsidizing that purchase. So that's how the economics of that work. And that's why you don't necessarily want to see wireless equipment growth. You want to see wireless services growth. That's what's going to drive the economics of the business. And then the other trend that's moving in the right direction, capital expenditures coming down $4.3 billion in the last year. Cash from operations is going up up just 0.4% in the past year. But that means that there's more free cash flow coming into the business. Verizon can do a couple of things with that. They can pay dividends and they can also pay down debt. For the next year, we'll see what numbers look like after the first quarter if this continues to be the guidance for the year. Wireless service revenue expected to grow a little bit, 2 to 3.5%. And capital expenditures expected to stay where they were last year. And capital expenditures expected to come down a little bit from $18.8 billion a year ago to now $17 to $17.5 billion. So frees up another $1 to $1.5 billion in cash. So all of these trends generally moving in the right direction for Verizon. And that's exactly what you want to see. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, the biggest critique of Verizon is going to be the company's debt. You can see here that debt has not come down significantly over the last couple of years, just a little bit. In fact, when you add up short-term debt, which is debt that's due within the next year, and long-term debt has actually risen slightly over the last couple of years. This is in part because of the build-out of their 5G wireless network, and in part because cash flow from operations, the core operations, were just not doing all that well a couple of years ago. This is what I'm going to be watching in 2024 is, can Verizon pay down $3, $4, $5 billion worth of debt each quarter? I would much rather see them pay down debt than I would increase the dividend. The dividend yield of 6% really doesn't matter if the company's going into too much debt and now suddenly we're spending billions and billions more on interest payments. Let's look at that chart right here. This is the interest expense on a quarterly basis. This isn't even a trailing basis. If you look at the trailing numbers, it's up to $5.5 billion. So if Verizon pays off more of its debt, it's going to have less interest to pay each year. And I think this is the fundamental tension for investors about Verizon. Yes, it's great that the company's generating a lot of free cash flow, but if interest rates stay where they are, which I think it's likely that they will for the foreseeable future, we're going to see that interest expense continue to climb. At the market rate, it's probably going to be $7, $8 billion a year in interest expense just from the debt that's already on the balance sheet. So, like I said, that's what I would like to see management be more aggressive on in 2024 is paying down that debt, reducing the risk in the business, because I think everything else is going relatively well. This is going to be a slow and steady growing company with wireless services. I think we're going to see more bundling. So not only wireless with broadband, but also look for Verizon to be a place where you can bundle content together. So as these streaming services look for places to distribute their content, it's going to be great for them if they're bundled in with a service like Verizon. That would make it much less likely that you're going to cancel something like Disney Plus or Hulu or Netflix. So that's a growth opportunity for Verizon. I think the core operations are doing well. Now it's a matter of keeping that momentum going and reducing risk in the balance sheet. So I'll be back here when results come out after the first quarter in the next couple of weeks. But let me know what you think about Verizon stock in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you next time.